Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data. Because in the last 7 days, 340.6 million XRP has left centralized exchanges in what on-chain analysts are now describing as a supply blackout, the most concentrated supply removal event in XRP's trading history. The culmination of that 7-day drain was a single batch of 25.2 million XRP transferred to an institutional sovereign custodian in one transaction. Whale activity now accounts for 91.4% of all exchange outflows, while retail participation has collapsed to 8.4%. And here is the number that reframes everything. Major OTC desks are currently quoting XRP at a 20.2% premium above the public exchange price. Institutions are paying above market right now because a $40 million market buy on public exchanges would trigger 10% price slippage. Stay with this analysis until the end because Washington D.C. insiders are reporting a finalized draft for a digital trade and commodity executive order that classifies XRP as a national interest digital asset. And the structural floor calculation that classification produces is $6.45, not the price retail is currently selling at. The 20.2% OTC premium is the single most important data point in today's analysis, and it requires the kind of precise unpacking that the headline number alone does not provide. An OTC premium of 20.2% means that institutional buyers, entities with compliance obligations, fiduciary duties, and analytical teams running quantitative models have determined that XRP at 20% above the public price is still the correct price to pay for the supply they need. That conclusion does not emerge from optimism or sentiment. It emerges from a calculation that weighs the cost of the premium against the cost of the alternative, attempting to source the same volume through public exchange order books. A $40 million market buy triggering 10% slippage is not a theoretical risk. It is the documented current depth of the public order book following 340.6 million tokens removed from exchange supply over 7 days. The OTC premium is the institutional market's real-time valuation of what XRP supply is actually worth when the public float has been compressed to the point where large purchases are mechanically impossible without moving the price against the buyer. David Schwartz's reality check on retail price predictions deserves analytical attention precisely because of what he chose to address and what his framing signals about the institutional thesis. Schwartz explicitly dismissed the $10,000 retail prediction narratives that circulate in the XRP community, not because the long-term institutional math is weak, but because framing the XRP thesis around 5-digit social media targets obscures the verified banking mathematics that actually govern the asset's structural repricing timeline. The framework Schwartz is directing analysts toward is Standard Chartered's verified structural targets, $2.80 in 2026, scaling to $28 by 2030, driven by cross-border liquidity capture and ETF inflows. These are not community predictions. They are the published outputs of Jeffrey Kendrick's institutional research at one of the world's most systemically significant trade finance banks. When a Ripple CTO actively directs market attention toward a bank's institutional research note, rather than community price speculation, he is signaling that the institutional math is the relevant framework, and that the timeline it describes is the one that the internal deployment sequence is calibrated against. Standard Chartered's $2.80 to $28 structural target range requires the analytical precision that distinguishes it from every retail price prediction circulating in the community. Jeffrey Kendrick's methodology begins with a specific and verifiable market capture thesis. XRP's absorption of cross-border liquidity flows currently routed through correspondent banking infrastructure, combined with the institutional ETF inflow projections that the Bitwise and Canary applications represent. The $2.80 near-term target reflects the price required to service the cross-border liquidity volume that is transitioning to XRPL infrastructure in the current regulatory environment. The $28 target by 2030 reflects the price required when the full ETF inflow trajectory, projected at $4 to $8 billion, has been absorbed into the US Spot ETF structure, and the correspondent banking migration has reached the scale that the DTCC's Tokenization Working Group is being designed to process. These targets are not aspirational. They are the outputs of a liquidity model applied to documented institutional demand projections. The $6.45 structural floor calculation introduces a third analytical dimension that operates independently of the Standard Chartered ETF and cross-border thesis. the national interest digital asset classification implied by the leaked executive order draft. If the digital trade and commodity executive order is executed as reported, XRP receives a strategic commodity classification that formally recognizes it as a settlement asset for U.S. national trade infrastructure. The floor calculation that institutional desks are running in response to that classification begins with a specific operational requirement: the minimum XRP price needed to handle $30 billion in daily trade corridor volume as a nationally designated settlement asset without generating liquidity fractures that would compromise U.S. trade settlement reliability. At $30 billion in daily volume against the current circulating supply and projected institutional custody rate, the structural unit price floor is $6.45. This is not a valuation model, it is an operational minimum, the price below which the national settlement infrastructure cannot function at the designated volume. The executive order's reference to Section 6 of the Clarity Act is the legislative connection that makes the $6.45 floor calculation legally binding rather than analytically projected. Section 6 established the Digital Commodity Safe Harbor, the statutory provision that exempts qualifying digital assets from SEC security classification under secondary market trading conditions. When an executive order building on that statutory foundation classifies XRP as a national interest digital asset, the classification does not merely describe XRP's role in the infrastructure. It creates regulatory obligations for the entities operating that infrastructure. Federal agencies, DTCC regulated clearing participants, and banking institutions operating under Federal Reserve oversight become subject to regulatory frameworks that treat XRP as a designated settlement asset. The compliance obligations that designation creates for those entities are the institutional demand drivers that the $6.45 floor calculation models. Compliance-driven demand, as this channel has consistently noted, does not fluctuate with retail sentiment. The DTCC's private proof of concept for tokenizing private equity directly on the XRPL represents the most operationally significant development in the DTCC's blockchain engagement history, because private equity tokenization is not a retail product. Private equity, the asset class comprising investments in non-publicly traded companies, leverage buyouts, and growth capital funds, represents approximately $13 trillion in global assets under management, held by pension funds, sovereign wealth funds, endowments, and family offices. These are the most sophisticated institutional investors in the world, operating under the strictest regulatory oversight and the most rigorous due diligence requirements. When the DTCC initiates a proof of concept for bringing that asset class on-chain via XRPL infrastructure, it is not experimenting with blockchain technology. It is evaluating XRPL as a settlement layer for the institutional asset class that its most systemically important clients depend on for long-duration return generation. The war room meetings that preceded this proof of concept were not exploratory discussions. They were the final stages of a due diligence process that the POC is now executing. The U.S. Spot XRP ETF AUM crossing $1.85 billion adds the regulated capital flow confirmation that the supply compression narrative requires to be analytically complete. The $24.2 million absorbed in the closing bell session today did not enter the market through public exchange order books. It entered through the ETF creation mechanism. Authorized participants purchasing underlying XRP to deliver into the ETF structure in exchange for new shares. That purchase pressure is invisible in the public price chart because it is executed through the custodial infrastructure of the ETF product rather than the visible retail order book. The $1.85 billion in total AUM represents institutional capital that has entered the XRP market through regulated fund structures and is now held in custody, contributing to the supply compression that makes the 20.2% OTC premium not just understandable, but mathematically predictable. Every dollar of ETF AUM is a dollar of XRP removed from the tradable float permanently for the duration of the fund's operation. The convergence of the 91.4% whale dominance figure, the 340.6 million token 7-day supply drain, the $1.85 billion ETF AUM milestone, and the 20.2% OTC premium creates a market structure that analysts are describing as a pre-liquidity fracture condition. A liquidity fracture occurs when the available supply on public exchange order books is insufficient to absorb a sudden demand surge without a discontinuous price movement, a gap rather than a gradient. The specific trigger threshold that analysts are modeling for the current order book depth is a $40 million single buy order. Below that threshold, the market can absorb demand without fracture. Above it, the price gaps through the remaining ask inventory to the next level of genuine resting supply. The institutional entities operating at 91.4% of exchange activity are not approaching that threshold through public order books. They are routing around it through OTC desks at 20.2% premium. The retail investor who sells through the public order book is the liquidity that makes the next institutional OTC purchase marginally cheaper. The retail participation collapse to 8.4% of exchange activity deserves to be understood as a structural signal rather than a temporary fluctuation, because the behavioral pattern it reflects, retail capitulation under sustained low volatility, is the documented precursor to institutional repricing events across multiple asset classes. When retail participation drops below 10% of exchange activity, while institutional accumulation simultaneously reaches 91.4% dominance, the market has functionally transitioned from a retail-driven price discovery mechanism to an institutional accumulation program. Price discovery in that condition is not the product of retail buyers and sellers finding equilibrium. It is the product of institutional buyers setting the price they are willing to pay for the supply they are extracting. And the price institutional buyers are willing to pay, evidenced by the 20.2% OTC premium, is substantially above the price that the retail seller is accepting on the public exchange. The transfer of wealth that this condition represents is not theoretical. The Evernorth NASDAQ filing, the Ripple Prime DTCC directory listing, the FedNow personnel bridge, the American Airlines enterprise use case, and now the executive order draft and DTCC private equity proof of concept represent a deployment sequence that has been executing in parallel across multiple institutional channels simultaneously. Each individual development, viewed in isolation, could be interpreted as incremental progress, viewed as a simultaneous multi-channel deployment executing against a defined regulatory timeline. The Clarity Act markup in the week of May 11th or May 18th, followed by the executive order that operationalizes the classification. The sequence describes a coordinated institutional infrastructure build-out reaching its visible deployment phase at the same time, because the underlying preparation work that each channel required was conducted in parallel over an extended period. The retail investor who is selling at $1.40 because the chart looks flat is making a timing error at the worst possible moment in that sequence. The complete analytical picture assembled from today's data produces one conclusion that the mathematics do not permit to be argued with. 340 million XRP has been removed from public exchange supply in 7 days. Institutional OTC desks are paying 20.2% above market to source the remaining supply without fracturing the order book. The ETF structure has absorbed $1.85 billion in institutional capital. The DTCC is running a private equity tokenization proof of concept on XRPL infrastructure. The executive order draft classifies XRP as a national interest digital asset with a $6.45 structural floor. Standard Chartered's banking mathematics project $28 by 2030. And David Schwartz has explicitly directed market attention away from retail speculation and toward the verified institutional math. The retail investor selling at $1.40 into this dataset is not taking a neutral position. They are providing the supply that makes the 20.2% OTC premium unnecessary and handing it directly to the institutional buyers who have already calculated where the price is going. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.